Imagine this. 3 different generations, 3 different lifetimes, 3 different sets of financial advice. And yet every one of them ended up stuck in the same trap. Your grandparents were told to save money in the bank. Your parents were told to buy a house, and you're told to just invest in markets or the next shiny thing. All of it sounded safe. All of it sounded smart. And all of it was a carefully packaged illusion. Start with your grandparents' era. They lived in a time when saving money in the bank was considered the ultimate form of prudence. It was the moral thing to do. Tuck away a portion of your paycheck, keep it safe in a savings account, and trust that it would be worth something when you retired. Governments encouraged it, banks advertised it, and families built their futures around it. But what happened when inflation hit in the 1970s? Ordinary savers watched helplessly as their nest eggs evaporated. In the United Kingdom, the pound lost nearly half its purchasing power in just a decade. Families who thought they were secure found out the hard way that money sitting in a bank account was not wealth. It was a melting ice cube. In Italy, the lira became notorious for losing value year after year, until savings held in bonds or deposits were practically shredded by devaluations. Across Europe and the United States, inflation silently confiscated people's savings. Your grandparents weren't reckless. They did exactly what they were told. But the system was designed to ensure that their safe path wasn't safe at all. Then came your parents' generation and the story shifted. After the devastation of inflation, the new wisdom was that the safest and smartest thing you could do was buy a house. Property never loses value, they were told. It always goes up. For decades, the house was marketed not just as a home, but as an investment. The problem is, a primary residence isn't an asset in the wealth-building sense. It doesn't generate income. It drains money every month through mortgages, taxes, maintenance, and upgrades. It's forced saving, and worse, it ties you to massive debt. In Spain, the real estate boom of the early 2000s felt like a golden ticket. Families stretched themselves to buy property, convinced they were building wealth. Then the 2008 crash came. Millions of homes plummeted in value, leaving families underwater, owing more than their homes were worth. Ireland's property market collapsed so brutally that whole neighborhoods were left half-built and abandoned. Even in the United Kingdom, families who bought at the peak of 2007 had to wait over a decade just to break even. Your parents weren't reckless either. They followed the rules. They did what they were told would guarantee security. And like your grandparents, they learned too late that the rules were designed to keep them trapped. What about you? The advice changed again. You're not told to save in banks. You're not told to just buy a home and sit tight. Instead, the message is, don't save, invest. Get into the market. The market always goes up. But does it? Now it's your generation's turn. You've been told that saving is pointless because interest rates are low. Inflation eats away at cash, and banks can't be trusted. The new gospel is investing. In stocks, and funds, and crypto, in whatever seems to be the next big thing. Social media shouts, don't let your money sit idle. Put it to work. And so people pile in. Some throw their savings at meme stocks, chasing quick profits. Others gamble on crypto, convinced that digital coins are the future of money. A few dive into NFTs, persuaded that digital art could be a once-in-a-lifetime investment. And while a handful of early movers made fortunes, the majority didn't. The majority did what their grandparents and parents did. They walked into a game where the house already knew how to win. The numbers prove it. During the crypto crash of 2022, more than $2 trillion in paper wealth was wiped out in months. Millions of small investors who thought they were building freedom saw their portfolios cut in half or worse. In Europe, supposedly safe pension funds, the kind people were told to trust for their retirement, nearly collapsed in 2022 because they were loaded with risky derivatives hidden behind the label of low-risk bonds. In the Netherlands, one of the most disciplined pension systems in the world, retirees saw benefits quietly reduced because returns couldn't match promises. Across the globe, young investors repeated the same pattern as older generations. They followed the rules of the day, and the system shifted under their feet. And this is where the sting really lies. Because the system doesn't change in its essence, it only changes in its packaging. Your grandparents were told to save, your parents to buy a house, you to invest. 3 different strategies, one identical outcome. Wealth flows up the pyramid, losses fall on ordinary families. Every generation thinks it's playing a new game, but it isn't. It's the same script replayed with new actors. Look at the underlying mechanics. Inflation is the first trap. It silently siphons value from wages and savings, making sure the majority never get ahead. Bubbles are the second trap. Housing, tech stocks, crypto, they inflate fast, suck people in, and collapse just as quickly, transferring wealth from the many to the few. Debt is the third. Whether it's mortgages, student loans, or credit cards, it locks people into obligations that can't be easily escaped. Together, these 3 forces guarantee that wealth is extracted from the bottom to the top over and over again. History rhymes here with brutal clarity. In ancient Rome, emperors debased the silver denarius until it was barely worth the metal it was stamped on. Ordinary citizens kept trading as if it was money, while elites protected their wealth in land and resources. In Weimar Germany in the 1920s, savings accounts were obliterated by hyperinflation, while those who owned tangible assets, factories, farms, or gold, emerged intact. In Greece, after the financial crisis of 2008, pensioners found their promised retirement benefits gutted, while foreign creditors demanded repayment first. The playbook never changes: erode, inflate, crash, extract, and as long as people keep following the rules they're told, they keep losing. But here's the part nobody tells you: not everyone lost. In every gold rush, the miners got wiped out. But the merchants selling shovels, tools, and jeans became rich. Levi Strauss built an empire selling denim to broke prospectors. In every inflation, those who owned productive assets held value while cash savers lost everything. In every housing collapse, those who rented smart or bought distressed properties walked away with gains while others drowned in debt. The system is designed to take from the many and deliver to the few, unless you understand the cycle and position yourself differently. And that's where the real lesson begins. So if every generation is told a new lie, what's the alternative? The answer isn't to despair. It's to stop chasing the traps and start thinking like the people who actually came out ahead. In the gold rush, the miners went broke, but Levi Strauss selling jeans and Samuel Brandon selling shovels got rich. During Rome's debasement, the citizens hoarding coins suffered, but the landowners and traders who controlled productive resources thrived. In the Great Depression, many who held stocks were ruined, but those who owned businesses that provided essentials, utilities, food, transport, often emerged stronger. The pattern is clear. The majority chases promises of easy security. The minority builds around real, enduring value. That means rethinking what you call an asset. A primary residence isn't an asset unless it generates income. A savings account isn't wealth if inflation eats it alive. A retirement fund isn't security if it's tied to speculative bets you don't control. Real wealth is found in things that hold or produce value over time. Skills that can't be inflated away, businesses that provide essentials, productive assets that generate cash flow even in downturns. It isn't glamorous, it isn't hyped, but it's the difference between being the miner who lost it all and the merchant who sold shovels for generations. So let's return to the story of 3 generations. Your grandparents lost to inflation because they trusted savings accounts. Your parents lost to housing bubbles because they were told a home was an investment. Your peers risk losing to speculation because markets and crypto are sold as guaranteed upward escalators. But none of this is inevitable. The mistake isn't just in following bad advice, it's in assuming that the system is designed for you to win. It isn't. And that realization alone is liberating, because once you see through the illusion, you can stop playing the wrong game. History doesn't repeat exactly, but the financial system makes sure the mistakes do. And unless you decide to break the cycle, you'll hand down the same illusions to your own children. But if you learn to build real wealth, in assets that endure, in value that others depend on, you step out of the trap. You stop being the fuel for someone else's fortune. You start writing your own rules. That's the real takeaway. Don't let inflation quietly drain you. Don't treat your home as your retirement plan. Don't chase bubbles dressed up as opportunities. Focus on building and owning the things that survive crashes, outlast hype, and create real value. Because when the dust settles, those are the people who still have their wealth and their freedom. If this gave you a new perspective, hit subscribe. History has the answers, and here we show you where to look.